load.
Awesome.
All right. So we were talking yesterday about an Apple 170 call. An Apple is 172. So you can either use call up if the market price is up from the strike price, call up. The contract is in the money or has intrinsic value. In that example, the Apple call contract has 2 points of intrinsic value. It's also going to be a great mnemonic for break even, call up, strike price plus premium. So if you only remember one thing about options, call up, put down. An Apple 170 put with Apple 172 is out of the money, makes no sense. It has to make economic sense. So the one other way we can do this is we can use a framing question. We can ask ourselves, is the contract likely to be exercised? Is it likely somebody wants to call Apple away, buy Apple at 170 when Apple's at 172? The answer is yes. Is it likely somebody wants to sell at 170 when Apple's at 172? The answer is no. Right? And so yes or no to that question sets up this idea of intrinsic value. Now, we said it's also important because if expiration of the contract has no intrinsic value, or if at expiration of the contract has intrinsic value, it will be exercised. So if that's an Apple 170 call and at expiration, Apple's north of 170, it's going to get exercised. And if there's no intrinsic value, it'll expire worthless. Now, be careful. Is that good news or bad news? That depends. That depends on whether you bought the contract or you sold the contract. So let's just play this little game here and saying that the option premium that you pay or receive is always going to be based on the intrinsic value and the time value. That equals the premium. And in fact, oh, geez, what happened? Okay, hold on. I just want to make this a little more relevant to today's price of Apple. And you can see Apple test question is very volatile. It has a high test question, a test question about volatility of a stock as compared to the market as a whole. What is that called? Test question, that's called beta.
Yeah, okay.
Apple has a high beta. It's moving around. Now, what we're asking about is the relationship of the strike price to the market price. Call up. So time value is determined by supply and demand. The key formula for us as test takers is intrinsic value plus time value equals premium. For us, the intrinsic value is way more important because I said they throw that terminology around a lot. And so you got to kind of be comfortable. Time value is going to go bye-bye. It's going to dissipate. It's going to be nothing at that. So factors in premium in excess of intrinsic value. So is the time value. That's the way I think of it. I think if we're paying 9 and there's 2 points of intrinsic value, that 7 is going to be the time value. The more time to expiration, the more the time value, and then test question. Remember this from the other day? Not important now, but when we do multiple option strategies, very important. Lower, higher, longer. Lower, higher, longer. Lower strike call contracts always have greater premiums. Higher strike put contracts always have greater premiums. And longer term option contracts always have greater premiums. We said the more volatility, the higher the beta. Now, by the way, when we say as compared to the market, we always mean the S&P 500. Or somebody's throwing around the market or whatever, you say, okay, everybody's using the S&P 500. All right, so let's play a little game on this and just get comfortable with these components of this. So the intrinsic value plus the time value equals the premium. We said for us, the intrinsic value is more important. There was the call contract we were looking at yesterday. It was a 40 call contract. As you recall, the premium was 4. And we're talking about this concept of the intrinsic value plus the time value equals the premium. So the first thing we have to establish is, does a 40 call with the stock at 41 have intrinsic value? The answer is yes. Now, there's a couple ways to get there. One way is call up. The market price is up from the strike price. Another way to get there, is it likely somebody wants to call the stock away, buy the stock at 40 when the stock's at 41? The answer is yes. So both of us confirm that this contract is in the money it has intrinsic value. So we said the premium consists of the intrinsic value plus the time value.
Quick question.
Yeah. Mhm.
Even with this is in the money and this
Yeah.
is a like good contract, even with the premium at 4?
Yeah. Good question. That concept has nothing to do with your long or short. See, it doesn't matter. We're not asking about the player.
Okay, well, that's one of the things I was
Yeah,
so
no, your point, your break even here is 44, but that's not the question.
I would look at this and say that like before I hopped on Zoom with you, I would look at this and be like, okay, call up at 4. I would just take away and like assume this is at 44 or 36 by now. Like,
Well, we're not talking about break even. We're talking about the relationship of,
got it.
right? So if I ask what is the intrinsic value of a 40 call with the stock at 41, the answer is 1 point.
Got it.
Different question is what is break even? Are you bullish or bearish? We haven't done any of that yet.
Okay.
Right. So the time value here is 3. Now, again, it's not testable, the conversation, but if you did buy this, Jackson, if you went long this contract, I say, Jackson, you have to be right about 3 things. You have to be right about direction. You'd be choosing up. You'd have to be right about how far up, 4 points, relevant to this discussion right now. We have to turn your time value into intrinsic value, Jackson, or you're going to be a loser. The contract you're paying 4 right now is only worth 1. And for you to break even, it's got to be worth 4. And so at 44, now that contract is worth the 4 points you paid for it. That
Got it.
conversation is not testable. What is testable, separate question, is what is the break even, not what we're discussing now. What's the max gain, not what we're discussing now. Max loss, not what we're discussing now. What we're discussing now is the relationship of the market price to the strike price.
And how do you get the time value again?
It's just everything in excess. So we have 2 components to a premium, the intrinsic value, and we have established that in this contract, the intrinsic value is 1. And we said the premium plus the time value equals the premium. And in this example, the premium is 4.
So then the time value is 3.
That's right. Everything in excess. Right. So, and that goes bye-bye. Now, but as I said, the more important thing for us is not the time value. For us as a test taker, the most important thing is the intrinsic value, because that's the language we're going to be throwing around a lot on the test. Right? You close out at intrinsic value. All right, so we're playing this game. We're just comparing again the thing. Here's this call contract. Now the stock is 39. So the stock was 41, but now it's 39. The strike price doesn't change, but what does change is the market price. And now we say, okay, call up. The market price is not up from the strike price. We use our framing question. Is the contract likely to be exercised? The answer is no. You're not going to call away the stock at 40. You're not going to buy the stock at 40 if you can buy it at 30. So now I say, same thing, Jackson. If you want to buy this option, now you're paying 4 points and it doesn't even include any time value, right? Because the intrinsic value plus the time value is the premium. There is no intrinsic value here. So now you would be paying the 4 points for the time value. And where the time value is going to go poof, poof. At expiration, it's only going to be worth its intrinsic value. All right, let's play a little game here. So here he is. Again, let me I'm just making this a little more relevant to where Apple's at today. And boy, I can tell you, boy, Apple's pretty volatile, right? You can see, it's there's some unhappy Apple shareholders right now, right?
Yeah.
Boy, Tim Cook,
Apple's pretty trustworthy though, I feel
yeah,
like.
yeah. He said he's in China, and boy, talk about trying to thread the needle there between, getting along and not getting along. They're not selling as many iPhones in China as they used to. Anyways, let me just fix that. Boom. A little more relevant to today's market price. Okay, so here we go. Boom. So what we want to be able to do as a test taker is make this comparison of the market price to the strike price. We said we have a couple ways to proceed. We have two great memory aid devices: call up, put down. We also have a framing question we can ask ourselves. Is the contract likely to be exercised? So let's look at this first one, call up. Now, remember your point. I'm not asking you about break even. I'm just asking about the relationship of the market price to the strike price. So here, the market price is above the strike price in the call, and so this contract is in the money. Synonymous with saying it's like learning a foreign language. That is synonymous with saying it has intrinsic value. And you say, well, Dean, what is the break even and all that stuff? I go, well, that's a different thing entirely. We don't know what the break even is, and we don't know whether you're long or short. That's not what we're asking about. What we're asking about is just the relationship of the market price to the strike price. Now, is it likely somebody wants to sell or put Apple to somebody at 170 when the stock is 172? The answer is no. That contract is out of the money. There's no such thing as negative intrinsic value. The contract either has it or it does not. There's no such thing as negative intrinsic value. What do we call the relationship when the market price and the strike price are the same? So again, what we're looking at is the relationship of the market price, CMV means current market value, to the strike price. That's called at the money. At the money. That's when the strike price is the same. At that point, anybody's guess. Right? So here at the money. Now, it's a different relationship for calls than puts. Again, what we're being asked about here is the relationship of the market price to the strike price. Call up, put down. Call up, put down. If the market price is down from the strike price, the contract has intrinsic value. The contract is in the money. Is that good news or bad news? Well, that depends. Yeah, it's not the question. That depends whether you bought it or you sold it or break even. We're just asking about that relationship. And there's no such thing as negative intrinsic value. The contract is out of the money. Is that good news or bad news? Again, you can't tell me that unless I tell you long or short and break even. That's not what we're asking. We're just asking about the strike price's relationship to the market price. Now, remember, the strike price doesn't change. It doesn't move, but the market price does, right? So this is a dynamic kind of a relationship.
Yep.
This was what that looks like. Boom, boom, boom. And again, when the option's in the money, that's synonymous with saying it has intrinsic value. All right, so we're going to do the same thing again. Now, here I'm kind of being a jerk because this relationship, again, has nothing to do with whether you're long or short. Has nothing to do with that. So, you want to make sure you're not getting, out of thing. Now, what I like to do, what Dean likes to do is intestable. But I always like to put the market price, the current market price, either above or below my strike to make my analysis. So, I just like to take my scratch paper, my official scratch paper, and say, okay, let me just put that above or below. And then what I'm looking at is that relationship. And we said that's the only thing I'm being asked about is this relationship of the strike price to the market price. And we have two mnemonics, memory aids: call up, put down. And is the contract likely to be exercised? So is it likely somebody wants to call ABC away, buy ABC at 40 when the stock is 45? The answer is yes. The market price is up from the strike price, and so that contract is in the money. It's in the money. In fact, it has 5 points of intrinsic value. Let's put that in there. Boom. Now, we don't know what the premium is, but it's going to be 5 points plus time value. 5 points plus time value. By the way, that wouldn't be any different. The answer would be no different if I said you were short the contract, because again, we're not asking about the player. We're just asking about the relationship to that. So when we're looking at this relationship, it doesn't matter whether you're long or short. It does not matter whether you're long or short. All right, let's look at our next one. So here again, the short has nothing to do with answering this question because we're not asking about the player. We're asking about the relationship of the market price to the strike price. Now, what I like to do, not testable, I like to put the market price either above or below just to make my analysis easier. And again, what we're asking about here is the relationship of the strike price 40 to the market price. We're not being asked about break even, max gain, max loss, any of that stuff. So we have two memory aid devices, call up, put down. And is the contract likely be exercised?
This is out of the money.
Right on. Good job. And there's no such thing as negative intrinsic value, right? It's either, boom, either is or isn't, right? Whoops. Yeah. Excellent. Now, by the way, if you are short this put, let's just see now, let's do the reveal here. And if you're short the put so far, things are looking good. I don't think anybody's going to stick it to me at 40 when the stock's at 52. I'd say, gee, you must be new. I'm here for you. I'm here for you. All right, let's look at our next one. I'll let you play. So it seems like you're getting the hang of it. So here's our next one. So is a 57 call in, at, or out of the money?
It's out of the money.
Excellent. Is a 80 put with the stock at 60 in, at, or out of the money?
In the money. 20
many
points.
Yeah, excellent, excellent, excellent. All right, so now here we go again. We're just playing this game. We're getting ready to do some strategies here in a minute, but we got to know how the pieces move around the board.
It's fine.
So we said the premium consists of two things, the intrinsic value and the time value. This is a 40 call and the stock is at 45. So what is the intrinsic value?
So the October 40 call, that's in the money, intrinsic value of 5.
All right, so we said the intrinsic value plus the time value equals the premium. So 5 plus something.
3.
Right on, right on. All right, so our next one here, it says it's a 75 put. The premium is 6. So is it have any intrinsic value?
No intrinsic value, out of the money.
That's right. And so that means if the premium is 6 and there is no
The time value is 6.
Excellent, excellent, excellent. It's a 30 put. The stock is 26. Oh my God. If you ever see this in the real world, call me, Jackson. I mean,
in the money.
Yeah, and there's no time value there, right? Which would never happen. 60 call and the stock, it's 5 points of time value, no intrinsic value. So that means the stock's got to be 60 or lower. All right, we're getting ready to play. So here we go now with strategy. So now we're going to open up some, do some trades and make some money, lose some money. I call this the options matrix. And, if you have the options matrix, you can orient yourself. So, we're going to be adding to this thing. But if I say, hey, what can you tell me about a long call? You say, Dean, when you're long a call, you paid a premium, you have a choice to buy the stock. Your max gain, we're going to be doing this in a minute, is unlimited. Max loss is the premium. What I'm trying to illustrate here before we even get started is somebody is long. We're going to know that anytime you're on this side of the matrix, it's not a box with 4 squares. The maximum loss is what you paid for the position. And anytime you're on the right-hand side of the matrix, where you agree to be a potential victim, the best case is you agree to be a potential victim and nobody victimizes you. And again, what I'm trying to show here is that this is not a box with 4 squares. Once you cross that, all of these things have a relationship to each other. Right? It's not a box with 4 squares. So we're going to be doing our first 4 basic option positions here. These are speculative. What we mean by speculative is we don't have the stock. We're just making a bet on the stock price. All right, so let's get started on this. Basic option strategies. Here's the matrix. We said we have 2 types of contracts, calls and puts. You can buy them or sell them. So we have 4 basic option positions. And so we're going to be looking at a long call. We have a right to buy, a short call. Every contract has 2 parties, a right to sell, an obligation to buy. Now, a test question. We said ultimately buying stock is bullish. And so whether you have a choice to buy the stock, long call, or an obligation to buy the stock, short put, those are bullish. And on the test, they'll say, what is the bullish or buy side of the options market? What is the bullish or buy side of the options market? And you would say long calls and short puts. We're not talking about buying the option. We're talking about ultimately buying the stock. Having a choice to buy the stock, having an obligation to buy the stock is what we call the buy side or bullish side, the same side of the market. And when you're short a call, obligation to sell the stock, long put, choice to sell the stock, selling stock is ultimately bearish. And so another test question would be, what is the bearish or sell side? And you'd say short calls and long puts. That's the same side of the market. All right, so now we're getting ready to play bullish. What we mean by neutral is that if you collect money, if volatility, nothing moves, then you're going to win, right? So if we buy sell an Apple 170 call for 9, and Apple is 172 and it remains unchanged, we're going to make 7 points. So that's what I mean by neutral. All right, so here we go. Our first strategy. Your customer goes long or buys 1 CHS, March 60 call at 4, when CHS is, who cares? It doesn't matter where the stock's at when we do the trade. It matters where the stock's at when we get rid of the trade, when we close it, right? So you can either memorize. I'm not very sympathetic because memorization is not a whole lot of stuff to memorize here. Call up. Well, it's not that difficult. So you can memorize, call up, strike price plus premium is the break even. I'm just going to illustrate that to you here. When we pay 4 points for the option contract, I like to use dollars out. Some people like to use debit. Some people like to use a minus, whatever floats your boat. I like to use a T, and then I like to track the money. So I paid 4 points for the choice to buy the stock at 60. Now, what I like about the T is it kind of walks you into the break even. What I mean by that is if I get my setup correct, then I can simply shop my answer set and look for the number offered to me that if I plug it in would make the columns balance, because that's what break even is, same dollars out as dollars in. And so maybe I'm looking at my answer set and the answer to me, choice B says the break even is 64. And I say, okay, well, let me plug that 64 into there and see if that makes the columns balance, because that's what break even is, same dollars out as dollars in. And indeed, I say, Jackson, we paid 4 points for the choice to buy at 60. If we can buy the stock at 60 and the stock's at 64, we break even. Now, I understand that you're not doing things to break even, right? People don't do things to break even. People do things to make money, right? And this is a choice to buy the stock at the strike price. And the reason that's important is because we want to know where we want the stock to be in relationship to the break even. We want the stock to be above 64. This is a bullish transaction. And again, we could, if we don't want to memorize stuff, I could just plug numbers in there and say, okay, if the stock's 66, yeah, I'm a winner. Right? If I plug 62 in there, I'm not a winner, right? So that break even is kind of helpful for us to know where we want it in relationship to that. So you're held accountable for 9 option strategies. That means you're held accountable for 9 break evens. The first break even, you're held accountable for break even in a call. It is strike price plus premium. All right, so nobody does things to break even. People do things to make money. And so this is unlimited gain potential. We paid 4 points for the option. We have a choice to buy the stock at 60. There is no ceiling. There is no ceiling. There's a finite supply, potential infinite demand. Long calls sound good. Hey, Jackson, how with as little as $400 would you like to control thousands of dollars worth of stock? How with limited risk would you like unlimited reward? And I had a client who kept losing money buying option contracts. His name was John. I was trying to, get him to flip a little bit and say, okay, if this keeps is a losing strategy, then maybe I should do the opposite. But anyways, I started the conversation by saying, Jackson, why do you keep buying these option contracts? And he said, Dean, you can't win if you don't play. I said, okay. So pretty easy to qualify somebody who wants to buy a call. I just say, Jackson, that $400 you can afford to lose. I mean, it's not bad because it's like a lottery ticket, right? It either comes through or it doesn't. And the max loss, that's our next thing we're held accountable for, is our max loss. And the max loss is just what you pay. Now, that sounds like a bad thing, but that's a good thing. That's a good thing because, there's things that you can do that you can lose a lot more than 4 points, right? So here you paid 4 points, contract expires, and you lose $400. By the way, there's a floor at 60 or lower. The contract has no intrinsic value. It will expire and you're going to lose $400. So hopefully that's not your rent money or, not your real money. They told you for everybody that's, a different number. I watch these reality TV shows and what people will do to humiliate themselves for $10,000. I go, man, I feel pretty blessed because I know what my number is, but it's not that. It'd have to be a bigger number. It'd have to be a bigger number. By the way, I also see people who are, do stupid, foolish things. I just saw a banker that lost his job and he lost it at Citibank. He was traveling internationally with his spouse and he put on his expense report lunch for him and his spouse. And, rather than just saying it was an accident, he said, well, no, I ate 2 meals myself. And compliance said, okay, really? So, I almost feel like as a compliance person, I probably should give you a warning. Say, Jackson, is that really the story you want to go with? I mean, this is, the time to, come clean. Or I would have just said, hey, it was an accident, man. I wasn't looking. I'm sorry. Yeah, just, reverse that. And this guy went all the way. Then he had the chutzpah to sue based on wrongful termination. I'm like, man, he lost. I'm thinking, God. By the way, it was sandwiches. I don't know what he makes as a international banker at Citibank, but I'm like, Jesus, why mess with it? Why mess with it?
Wait, so there's 9 break evens that you have to be held accountable for?
What's that?
There's 9 break even strategies that you have to be held accountable
remember,
for?
there's 9 strategies. We're on the first, a long call.
Okay.
Now, good news for us, it's going to be the same break even short call. So it's not quite 9. It's just where you need it in relationship. All right. So here's the one I just showed you just by way of review. We paid 4 points for the call. We could buy the stock at 60. Break even is what makes the columns balanced. That's the same dollars out as dollars in. We joked yesterday. That's when it's a push. Neither win nor lose. So 64 is the break even. Whether you want to do it through the T or whether you want to memorize, call up, whatever works for you. Maximum gain, wonderful. Maximum gain is unlimited. That's a wonderful thing. And if you lose money, if you're wrong, you just lose your $400.
Got it.
All right, let's give you one to try. So if you buy a CHS, March 60, call up for, are you a bull, a bear, a butterfly, a flamingo, a condor? What the hell are you if you buy a call?
Bullish.
Right on. If you exercise, if the contract is exercised, what will you be doing?
I will, if it's exercised, I bought the contract. So
that's right.
I gave my premium up and I'll get the stock at 60.
Excellent. You have a right to buy the stock at 60. So if I'm your broker and you call and you say, Dean, I want to exercise, that means you're buying the stock at 60. What is the break even?
Call up 60 plus 4 at 64.
Excellent.
Max gain, unlimited, max loss, 400.
Excellent. All right, let's do our next one. So we're short 1 SHC June 70 call at 5. So that's an obligation to sell the stock at the strike price. And so is that $5 out or dollars in? Is that $5 out or dollars in? That is dollars in. We're doing an opening sale. And we said that for 5 points, we would sell the stock at 70. Our break even is 75, strike price plus premium. Now, again, if you don't want to memorize break evens, if you get good at the T, you know that ultimately it's going to be a number that if you plug it in would make the columns balance, because that's what break even is. Break even is same dollars out as dollars in. Right? So I could shop my answer set and say, okay, they're offering me choice C. They say the break even is 75. And I say, indeed, if I buy that stock at 75 and I deliver at 70, I would break even. As we said, nobody does things to break even. People do things to make money, but this is a bearish transaction because we want the stock to be below the break even of 75. Right? 70 or lower, contract expires, neener, neener, neener. I get to keep the money. So break even is 75. Nobody does things to break even.
So it's obviously out of the money, like you said.
Yeah, 70, it's 70 or lower. It's no intrinsic value, it's out of the money indeed.
Got it.
That would be for us, that'd be a good thing.
Yep.
Maximum gain is contract expires. So we collected 5 points, 70 or lower, we get to go neener, neener, neener. We keep the money. That's our best case scenario. 70 or lower. I have an obligation to sell at 70. Nobody's going to make me deliver at 70. It's stock 68 or 66. If they did, I'd say you must be new. I don't know, Jackson, why you want me to deliver the stock at 70. I'm here for you. But, you could buy it in the open market at 68, my friend. Right? So that contract's just going to expire and I keep the money. Guaranteed test question. The maximum loss is unlimited because the most you're bringing into your account is 75. 5 points for selling the option. And the problem is we don't know what it's going to cost you to get out of this position. Now, there's 2 versions of a call. One version of a call is when you agree to sell stock that you own. So I'll play margin clerk. I'll say, hey, Jackson, you know that HSO call or HSC call, June 70 call you wrote at 5? You go, yeah. I said, well, it got exercised. And you said, well, Gene, I choose not to be exercised. I said, well, Jackson, you're a little confused. You don't have a choice. You have a
obligation.
And he said, well, what if I had the stock? I said, Jackson, if you had the stock, we wouldn't be having this discussion right now. If you had a covered call, you would agree to sell stock that was already in your account. I would have delivered it and you wouldn't be talking to me right now. And you say, well, gee, Steve, so what's the point? I said, well, you're going to have to buy the stock to make delivery at 70. And you say, well, gee, maybe the stock is less than 70. I say, well, again, my friend, you're confused. If the stock was less than 70, again, we wouldn't be having this discussion. Oh, you say, the stock is north of 70. I said, now you're catching on, Jackson. You said, well, Dean, I know I need to deliver the stock. I say, you do. You know where I can get the stock? I say, Jackson, every day between 9:30 and 4 o'clock, there's a market where buyers and sellers come together. And so you're going to have to go out in the open market and buy that stock. And he said, well, gee, Steen, what's the stock at? I say the stock is at 82. And you say, ooh, that hurts. I say, yeah, that hurts. You're going to lose 12 points, but you got 5, so you're going to lose 7. You say, I'm so glad it couldn't have got worse. I go, well, Jackson, I'm not going to get into it with you about the grammar, but, it could have got worse. Right? I mean, because how far up could that stock go?
As far as it wants.
Yeah, and finite supply, potential infinite demand. So this one doesn't sound bueno. How with limited reward would you like unlimited risk? That's not so good. This is like picking up nickels in front of bulldozers. Now, the test question is tell them people don't do it. I say, Jackson, there's a lot of ways to take that money without taking all that risk. You could do a covered call, you could do a credit call spread. There's a lot of ways to be a smarter bear. You are a very dumb bear here because you're a dumb bear because you're, getting picking up a picnic basket and you may get shot. That's not, not a very smart thing to be doing. All right, so here is one for you to try. What is your market attitude if you're short a call?
Bearish.
Right on. If I call you and say you got exercised, what are you going to be doing?
If it got exercise, I gotta buy the stock in the open market and sell it to my
Yeah, you're
guy.
going to be selling the stock at the strike price. Right on. What is your break even?
75,
Right on. Whoop.
500 max gain, obviously, because it's the
That
premium and
unlimited.
unlimited.
Yeah, that's very tough for that unlimited game.
Yep. Unlimited is uncovered calls,
That's
correct?
right. That's right. And
Yep.
here's the top part of our matrix now filled in, right? So I say, what can you tell me about a short call? You say when you're short the call, you receive the premium. You have an obligation to sell the stock at the strike price. Your maximum gain is the premium. Your maximum loss is unlimited. Your break even is strike price plus premium. You're bearish. You may not have any clue what you just said, but it is technically correct. Now, as I said before, this is not a box with four squares. We said every quadrant, matrix quadrant has a relationship, right? Every time you cross that line. By the way, what I'm kind of hinting at is if you get this quadrant here down, then you just know, okay, well, this is going to be the opposite, right? So that takes care of the top half of that matrix by just knowing one quadrant. All right, so now what we're going to do is we're going to move on and work on the bottom half of the contracts matrix because we have two types of contracts, calls and puts. You can either buy them or sell them. So we have four basic option positions. And we have two great memory aid devices, call up, put down.
So call up, put down refers to the break even.
Yep. Yeah, and the
Got it.
relationship and intrinsic value. All right, so this is a choice to sell. This is a choice to sell. This is a choice to sell at 80. And is that 7 money out or money in? Is that 7 money out or money in?
The seven's money out.
Yeah, so you paid 7 points to be able to stick the stock to somebody at 80. And we said if you get good at the T, you know it's the number that would make the columns balance because that's what break even is. Same dollars out as dollars in. Now here, right, if you were going to stick to somebody to stock at 80, you're going to buy the stock and stick it to somebody at 80. So you can either memorize, put down, or you can shop the answer set, assuming you did the setup right, and say, okay, I need a number that if I plug it in there is going to make the columns balance. And so I say, okay, let me try 73. If we buy the stock at 73 and we stick it to somebody at 80, we indeed break even. I'm just illustrating that's the break even. Now, nobody does things to break even, right? We don't do things to break even. We do things to make money. So here we're bearish. We need the stock to go below 73. Because, for example, if it goes to 72, that would be wonderful. Now I'm a winner, right? Because I got more money in than money out. If 72 is good, then 68 is better still.
Yep. To be honest with you, I think I understand
Good,
this
good, good, good.
section. Do you mind if we move on to the next?
I love it. Absolutely. So, okay, let me just make you prove it.
Yeah, that's fine.
All right, so I'm going to make you prove it. What is your market attitude when you buy a put?
Buy put bearish.
Right on action. So you exercise, what are you going to be doing?
I have an obligation to. I I
Obligation.
have I have the right
There you go.
to sell a stock to my guy.
There you go. Break even.
Break even would be 80 minus 7, so it'd
Right
be
on.
73.
Maximum gain.
Max gain would be my break even, and maximum loss would be
You're kind of a strange guy, as I said, Jackson. So, for that score, we were talking about this the other day. You do seem to have a better understanding than your scores would indicate. And as your tutor, it shows up when we're playing this game. I'm making you prove things. You're proving that you do indeed have an understanding of it.
I
So
think I might have got that wrong though, real quick. The max gain and the max loss.
that break even, you said the max gain was the break even. You're correct. That's 73 points on 100 shares. That's $7,300.
But the max gain would be 73,
Yeah, that's 70
7,000.
to zero. That's the same thing.
Okay. Um,
If the
I'm at-
stock goes to zero and you stick it to somebody at 80, you'd make 80 points. You spend 7 to get going. So you would make 73, and 73 is the break even on 100 shares. So you make that. There's a lot of ways to think about it, but it's when it goes from the strike price 80 minus 7, break even to zero. When that stock goes all the way to zero, that is your max gain. You told me 73. I accepted that.
yep. So
73
how are we getting 7 grand though?
because 100 shares, 73 points on 100 shares is 7,300.
Yep. And then max loss would be the premium.
Yeah,
Got it.
shouldn't be struggling with that. Shouldn't be struggling.
No, I'm not.
All the bearish strategies, that's the smart one, right? Because if you're wrong, okay, let's have you prove it here, another basic position before we move on.
Yep. Market attitude, obviously bearish
But
or
no,
bullish. Sorry.
that's all right. Because take a deep breath here, because
Yep.
I believe that you know this. You said you did, and then I
Yep.
rudely prove it.
No. As I
And now I'm
should.
making you prove it. And
Yep.
instead of taking a strategic pause, you're jumping a little bit, and you got to get, in the Marine Corps, when you're shooting, there's a concept of you don't want to get, wobbly, get what I'll use the hunting example. It's called buck fever, right? We take you out hunting for the first time and you see a buck and then you got him in your sights and then, you can't squeeze the round down range.
Yep.
Make sure that when you're, leveling off your sights and you breathe and relax. So here's our market attitude. I said, prove it. This is bullish.
Bullish. Got it.
Okay. If you get exercised, what are you going to be doing?
If you get exercised, you will, you can buy it.
There you go. You have an obligation to buy the stock. Break even.
73.
Excellent. Maximum gain.
Maximum gain would be my premium,
Excellent.
and
Max.
maximum loss would be the opposite. So it would be the same. Okay.
Okay. So there's now the bottom half of the matrix. Here is the matrix in all its glory with all of the basic option positions. So you said, you know what? If you didn't, you can use this as kind of an anchor, get yourself oriented in these 4 basic option positions, right?
Mm-hmm.
All right. So moving on, stock plus options. So I think the binary thing you want to be able to do as a test taker is say, is this a speculative position or is this a stock position? Because the stock dominates. Always let the stock position control. We don't want the option tail wagging the stock dog. You always hedge with the opposite market direction. Hedging is about what if you're wrong, not about what if you're right. So if you own the stock and you're right, it goes up. So the hedge is what if it goes down? Now, 98 out of 100 times when you hear the word hedge or protection, it's going to be buying an option. So that means you're either going to buy a put or buy a call. And when you hear income, it's either going to be selling a call or selling a put. It'll never be sell a put for income. It'll be selling the call. All right, so here's our first stock plus options. So your customer buys 100 shares of ABC at 40. Is that money out or is that money in?
100 shares at 40. Money in.
Money out. When you buy the stock, money out. Now, if you didn't do a hedge, if you didn't have a hedge, your maximum gain would be unlimited. Your maximum loss would be 40.
Got it.
Because there's no floor and there is no ceiling. Right? There's no floor. Well, there is a floor at 0, but there's no ceiling. And so you say, Dean, I think I want to do some construction. I want to put in a hedge. I said, oh, you want to put in a hedge? You say, yeah, Dean, I think I'd like to establish the choice to sell the stock I own at 40 at 35. I'd like to buy a put, a protective put. Is that money out or money in when you buy a put?
Money out again because you're buying it.
Now be careful. I don't know if I should tell you common mistakes, but a common mistake here is to not see that's a stock position and tell me it's 32 is the break even, and maximum gain is break even to zero, and maximum loss is $300, and this is not a put position. This is a stock position. Now the break even test question here, it's the one time and the one time only that we're adding to get the break even. It's going to be the stock cost plus the premium. So the break even here is 43. Because I paid 40 for the stock, I paid 3 points for the protection. So again, you
Okay.
can memorize stock cost plus premium, or you can get good at the T. Now I have unlimited gain potential because I don't have to sell the stock if I don't want to. Still have unlimited gain potential. Here's why you did this. You are pretty smart here because now anytime you want, you can exercise your put and get out of this position. And you can sell the stock at 35. So that's pretty cool. That's now you're going to be your maximum loss is the break even to the strike where you got that floor at. So now instead of falling down 40 flights of stairs, now that's what you would have fell down if you had just done this stock position, you could lose 40. But now instead of falling down 40 flights, you only stand down 35. So the maximum loss here is the break even 43 to the strike price. The maximum loss here is 8 points. Why do you do this? Test questions. Suitability is always huge on the test. You do this to participate in a big price increase, but not participate in a big price decline. That's pretty cool, right? I mean, this is a pretty good strategy. I say, I'm your ROP, your registered option principal. I say, Jackson, what's this guy want to do? And you say, Dean, he wants to have puts on stocks that he owns. Like, oh, smart guy, no worries. All right, this is very testable. Covered call, you could see maybe 3, 4, 5 covered call questions on your test. I told you the vast majority of the questions are the basics and a covered call. So again, be careful. I can't tell you how many people get hung up here because they don't recognize the stock dominates. This is not an option position. So the minute you see the stock, you say, okay, I got to stay focused on the stock. This is a bullish position. You wouldn't be buying stock. And I say, hey, how would you like to agree to sell high stock you bought low? Somebody will pay you, Jackson, 7 points to agree to sell at 45 stock you just bought at 40. Pretty cool. And again, you got to be careful. People say, oh, it's break even. It's call up 52, unlimited loss, limited gain. This is not a naked call. This is a covered call. So 40, this is the one time and the one time only that's not call up. So we paid 40 for the stock. That's dollars out. We brought in for the option, kind of cool. We did lower our out-of-pocket cost, and that's a Bueno thing. We brought in 7 points, and so that's going to be good. And so we lowered our out-of-pocket cost from 40 to 33. Our break even, remember, is what makes the columns balance. So if you get good at that setup, you can shop the answer set, or you can memorize 40 minus 7. Now, the disadvantage of this strategy is you do not participate past the strike price. That is not bueno. So what I mean by that is you got 7 here. And the best case scenario is that somebody calls the stock away from you at 45. You don't participate past 45. There's a ceiling there. So the maximum gain here is 12 points. The 5 points that you got from 40 to 45 and the 7. So you don't participate past the strike price. You're still a loser if the stock goes to 0. You're still a loser if the stock goes to 0, but you're less of a loser because you get to keep the premium. Right? So those you can lose is 33. Very testable. Why do you do a covered call suitability? To generate
Income.
Additional income. All right, let's finish our session with a couple practice questions, and let's see how you do on some practice questions.
Okay.
Most protection on a long stock position.
Most protection on a long stock position would be a um most protection on a long stock position would be hmm,
So you bought the stock.
shorter call.
Never, 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 never short. When they say protection, it's always long.
Okay. So long and put.
Always, yeah, long put. You're going to marry MRRY a put to the stock position, right? So the minute you hear hedge or protection, it's either A or C, right? It's going to be long. It's going to be the offset. You want to have a choice to sell the stock you bought. All right, chance to redeem yourself.
All right.
You want to generate income on a long stock position.
That's protecting the long stock position. In
Not
other words,
protect,
right?
not protect, generate income.
Generate income.
Means it's either B or D. Income means you're selling the option.
Okay. Then if you want to generate income, shorter call.
There you go. Cover call. Very, very testable. Very, very testable. All right, let's try some practice questions here, and we'll call it end of our session. And those are advanced option strategies. And boom, 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 boom. Come on, let me just go skip to the part where we do some questions.
So protecting a long stock,
Long
you
put. When you want to
long
protect a
put,
long put, it's going to be a long put.
and when you want to generate additional income, you short a call.
That's right, exactly right. Very testable suitability. Okay, so let's try a couple of test questions here. A customer buys
Awesome.
10 ABC July 25 calls at 4.5. What is the total premium paid for the position?
So a customer buys 10 ABC July 25 calls at 4.5. What is the total premium pay for the position? The total premium is B, 450.
There's 10 of them.
Oh, 10 of them, so it's D.
Yeah, make sure you
Gotta
be
read the full question, yeah.
RTFQ, right?
Yeah,
RTFQ. So
got it.
an investor buys an ABC May 45 put at 4.25. When the stock is trading at 43, who cares? Intrinsic value is about the relationship of the strike price 45 to the market price. And now they're not asking you what is the intrinsic value. They're just asking it has intrinsic value when the stock is.
So
So
we're not looking for the break even here.
yeah, we're just looking below 45, right?
Yep.
That's when it has it. Now, of that 4.25, 2 points is intrinsic value and 2.25 is the time value. And remember, for us, the more important concept is intrinsic value. So what is the break even in this transaction? If you buy a 45 put at 4.25, put down 45
Minus 425, which would
yeah,
be
so
41, 41.75.
40.75, right? What's the max gain?
The max gain an investor buys, let me see, may put max gain is the premium
That's right. Well, no,
is
no.
the
You had this right before, so you're going a little backwards on me. The max gain is when it goes to zero.
okay.
Yeah, remember the break even to zero, $4,075. Max loss.
Max loss is the premium.
There you go. Bullish or bearish?
You're bearish here.
Yeah, you're a smart bear, by the way, because if you're wrong, you're just going to lose the premium. If your customer owns 100 shares of stock, now once you hear 100 shares of stock, you should say, okay, he's interested in selling the stock he owns. So it's either going to be a long put, choice to sell the stock he owns, protection, or it's going to be a short call, generate additional income. So he has 100 shares of stock. He's, again, not speculating. He wants to participate in a big price increase, so he doesn't want to have a ceiling, but he doesn't want to participate in a big price decline. He wants to put in a floor. You may recommend.
So if your customer owns 100 shares of stock and wants to participate in a big price increase and not participate in a big price decline, you may recommend. So he wants to participate in a big price increase, not participate in a big price. So he wants a big gain
That's right.
without losing any.
Yep.
Um, he wants a big gain without losing any. So I would say I think this would either be B or D.
So which one are you going with? You're correct. It's
Yeah. And um I'm gonna go with D, buying puts.
That's very much a test question. You got it right. And everything you said was right. So your tutor, I was a little concerned because you said everything correct. I thought, man, after he says all that good shit, if he gets the wrong answer, I'm going to be upset. Right.
Yeah.
So, yeah,
Can
you
we
got to buy
walk
the
through this?
put, right? You're putting in the floor. You're putting in that floor. You're doing construction.
Yeah, so the reason it's buy a put is because he can have a gain, but um
Yeah, you're,
there's no unlimited loss here.
yeah, that's the smart thing you're doing here, right? You should have known it's not selling puts because that's an obligation to buy the stock. You've already done that.
Yep,
You don't want to buy the stock. You want to sell the stock. All
got
right.
it.
An investor with no other position buys one CDE May 65 put at 3.5. If the investor buys the stock at 63.5 and exercises the put, what is the investor's profit or loss?
Okay, so the investor with no other position, okay, buys. So let's just say Jackson buys one
I like it. Put
May.
yourself in there. Do you, as your tutor, I would prefer you make a T. So when
Okay,
Jackson buys this at 3.5, is that 3.5 money out or money in?
he buys it at 3.5, so I bought it at 3.5, so
Money
that
out.
is money out.
Okay. And then you bought the stock at 63.5. Money out or money in?
Money in because I bought the stock.
My stock isn't money
Oh,
in.
sorry. Money out because I bought the stock. So I
So
sent the
you're
money
out
away.
3.5 for the put. You're at 63.5 for the stock. So thus far, Jackson is out 67.
Yes.
You
So this is
exercise your choice to sell at 65. So
so
what is
that
profit or loss?
the loss is 350,
2 points, right?
2 points.
Jackson paid 3.5 for the put. He bought the stock at 63.5. He exercised his put. You exercised your choice to sell at 65 to get back at least 1.5 of the 3.5 you spent. You're still a loser.
Mm-hmm.
You didn't lose everything. You only lost what? 2. And the reason you lost 2 instead of 3.5 is because your contract still had some
Intrinsic value.
intrinsic value. Boom. A customer owns 100 shares of stock and wishes to generate additional income in that stock. What option strategy would you recommend?
Customer who owns 100 shares of stock and wish to generate additional income on that stock.
So when you're generating income, is that money out or money in?
Money in.
So it's got to be a short option position. You got to sell an option. So now you got to decide: are you going to sell a put, an obligation to buy, or are you going to sell a call, an obligation to sell?
And I want an obligation to buy.
To sell, you already own the stock.
Okay.
So this is a
So it'd
cover.
be a covered call.
That's very testable,
Okay.
super testable. I mean, you could get 3, 4, 5 questions on that.
Really? Okay.
Yeah.
So, okay.
All right. So I think that's a good time to call it a day.
Yeah.
We will, if we pick it up next session, we can either do the advanced option strategies. We got to move on to mutual funds and munis.
Yeah.
As your
So
tutor today,
I